What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about Jerome Powell's second day at the testimony that he gave in front of Congress in the US Senate, of course, in front of the Housing Affairs and the Housing Financial Services Committee. And also we've got inflation numbers coming out in less than 6 hours. We've got CPI numbers bright and early at 8:30 a.m. Eastern. I will be live to cover those numbers, and I am traveling at the moment, so I'll try my best. 99% probability that I'm going to be live, 1% due to any technical issues that I may face related to the Wi-Fi here at the hotel. But I'm going to try my best to, of course, be available and live at those at that time when the CPI numbers come out. So hope you all enjoy this video, find it helpful. Make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. I would really appreciate that. And links to our Discord and Patreon is going to be down below if you're interested in joining us and, of course, getting access to the entire MoneyVest platform. There's about 4 more spots left that you can take advantage of with a 51% discount, and of course do a full fundamental analysis on individual stocks. And we've got a lot of really cool functionality and features coming out in the future with portfolio tracking, risk analysis, macro dashboard, our MoneyVest index, a lot of amazing things that we're going to be building on this platform. So for now, you can pretty much do a full fundamental analysis on individual stocks. So links going to be down below for you to take advantage of that as well. So we'll love to have you on board. So first things first, the NASDAQ here up a little bit over 1%, the S&P 500 up over 1% to 5,600 for the first time ever. The Dow Jones almost at 40,000, up another 1% on the day here. So the markets had nothing but an increase every single minute, and of course pushing higher to new all-time highs. This right here is going to be the CPI expectations for today. So at 8:30 a.m. Eastern, we're going to get those numbers. The consensus is for a 0.1% increase month over month, year over year at 3.1%. Core CPI, when you exclude for food and energy, we're looking at 0.2% month over month, and year over year sitting at 3.5% for consumer price index. And Jerome Powell, of course, talking a lot about the economy, the banking regulations, and of course interest rates and inflation. And these are some of the things that he mentioned in day 2 of his testimony to US Senate and of course the Congress. So ultra low interest rates aren't coming back. So interest rates aren't going to be at near zero territory as they were about 15 as they were for most of the 15 years before the pandemic, and of course during the pandemic as well. And I think we probably won't go back to the era between the global financial crisis and the pandemic when rates were very low and inflation was also very low as well. And again, you know, this is kind of Jerome Powell reiterating the idea that, look, ultra low interest rates are not going to be a thing anymore. But of course, nobody knows what the future holds. There is a possibility. And again, if things were to change with regards to unemployment, with regards to the economic growth, with regards to where we are in terms of the labor market and just the overall state of the economy, yes, it is hard to say that, okay, interest rates are going to be down back to ultra low levels or near 0% because the labor market's very strong, economy is growing, so we don't really need to lower interest rates to stimulate the economy. Right? So one of the things that we have to understand is that why do we cut interest rates in the first place, right? What's the incentive? And that's actually one of the things that I've mentioned time and time again in my previous videos is that Jerome Powell and the Federal Reserve needs a reason. They need a reason. They need an incentive. They need something to fix, because if it ain't broken, don't fix it, right? So right now there's nothing broken in the economy. Labor markets continue to do really well, although we have seen a bit of an increase in unemployment from last Friday. So we did get up to 4.1%. Economic growth is very strong, still growing at 1.4, 1.5% on a year-over-year basis on an annualized rate for the entire GDP of the US. And inflation is the only big concern that Jerome Powell and the Federal Reserve and everybody else has, right? How do we get inflation back down to 2% or closer to 2%? That's the main goal. However, if anything were to break, if economic conditions were to worsen, if there was any contraction, if unemployment were to skyrocket, yes, there is a possibility that quantitative easing is back on the table and ultra low interest rates are back on the table as well. But that would only be for a temporary period, right? In order for interest rates to stay low, inflation would have to be low as well, right? Because Interest rates are only increased if they're trying to fix inflation, which is what they're doing right now. Moving forward, Powell sees a path to a soft landing for the U.S. economy. So a U.S. economy or U.S. recession or a meaningful increase in unemployment won't be required to get inflation down to 2%, is what Jerome Powell said. And there is a path to getting back to full price stability while keeping the unemployment rate low. There is that path. We've been on it. We're very, very focused on staying on that path. Folks, remember what Jerome Powell is talking about here. As much respect as I have for Jay Powell, as much as I trust in his ability to steer the U.S. economy out of this recession, out of this inflationary period, he has given us very bold statements and predictions in the past, inflation being transitory, which obviously was not the case. And this right here, there is a path to getting back to full price stability, which is 2% or lower inflation, while keeping unemployment rate low. Remember this statement. I feel like there's going to be a time 6 months, 12 months down the road where unemployment is nowhere near to those low levels and we are much, much higher. Even if that means we've gotten inflation back down, unemployment has a risk of moving higher. So to make a statement like this, Jerome Powell has to be very careful. And the way I would word it is a little bit differently. I would simply say that there is a path to getting inflation down to 2% while not making unemployment worse than where it is right now. Just saying that unemployment rate is low, right? Its unemployment rate was low at 4% at 3.9, 3.8%. It is now starting to move higher. It is potentially going to get even worse if interest rates stay higher for longer. There's a lot of jobs that are being replaced by automation, by robotics. There's a lot of jobs that are just simply people are not hiring, businesses are not hiring, and a lot of the jobs were actually created in the government sector, not in the private sector. So the private sector, there's been a lot of hiring freezes. In fact, they're the ones that are actually replacing a lot of workers with robotics, with automation. And for that reason, I do believe that unemployment, unfortunately, is on its way higher. And we could just, and this is a bit of a sort of case study as well. This is something we can discuss. There could be a time, in my opinion, in the future where unemployment is high and productivity is high because of automation, because of robotics, because companies become more productive if they're applying robotics and AI and automation and can just really buying humanoid robots to do a lot of the physical tasks or labor, and they're not really, of course, paying people to do that, right? So they're hiring humanoid robots and they don't have to pay them any benefits. They don't have to pay them any health insurance. There's going to be some maintenance, but they can work 24/7 around the clock. So more productivity, higher levels of unemployment could be a thing of the future if companies and businesses continue to adopt artificial intelligence, automation, robotics. So, in my opinion, I do believe there is a possibility that unemployment starts moving higher, and it actually does accelerate moving forward if interest rates are higher for longer and companies continue on this path towards artificial intelligence and robotics. Now, Fed can cut interest rates before inflation hits 2%. So this is probably one of the most bullish statements Jerome Powell made during his testimony. And he says that you don't want to wait until inflation gets all the way down to 2% because inflation has certain momentum. And if you waited that long, you've probably waited too long because inflation will be moving downwards and will be well below 2%, which we don't want. Now, the interesting thing is that it works both ways, right? It works both ways. Inflation, when it's on the way up, it is on the way up, right? So the interesting thing is Jerome Powell did not apply this philosophy when inflation was actually moving higher and kept calling inflation transitory, right? So it's kind of interesting how he comes up with this type of analysis is because he's talking about it's got some type of momentum, right? Inflation has momentum to it, right? If it's moving down, it's going to continue to move down. If it's going higher, it's going to continue to go higher. Now, this philosophy did not apply when he was calling inflation transitory because for whatever reason, but now this philosophy applies. Now, this philosophy also does apply to unemployment, right? If unemployment's moving higher, there's momentum. It's going to potentially keep moving higher. So interest rate cuts should really be considered in a balanced way, both from an economic standpoint and also from an inflation standpoint. But as I mentioned before, the risk of cutting too early is far greater than the risk of cutting too late. So that's why the Federal Reserve wants to take it slow, wants to be more data driven, wants to be more data dependent in order to understand that, okay, when we finally do decide to cut, it is indeed the right time to cut. They would much rather cut late than cut early. Just remember that. This is, I think, one of the biggest lessons that we need to learn about the Federal Reserve is that they would most likely, most Federal Reserve chairmen in the past also, we've seen they would much rather cut late than cut early. And the reason is very simple again, is because interest rate cuts happen fast. They happen much more quickly. They happen all the way down to near 0%, whereas interest rate hikes happen more slowly. They're spread across many, many months, and it takes a lot of time to get interest rates to where they are today. So every Federal Reserve chairman in the past has chosen to cut late rather than early. And that's what's really gotten us into this mess, because nobody can really foresee where inflation or economic growth is going to be, right? So for that reason, again, Jerome Powell is kind of employing a very similar strategy in a bit of a different sense. Now, Fed's balance sheet reduction has a good ways to go. The Federal Reserve's process of reducing its securities holdings will continue for some time. The central bank's balance sheet ballooned during the pandemic, of course, as they continue to buy bonds and treasury securities and mortgage-backed securities. And they have now declined by about 1.7 trillion from a peak of about $9 trillion. That, again, is going to continue. The markets continue to charge higher. New all-time highs, Apple pushing higher, Google, Meta, Tesla, Nvidia, Microsoft, AMD, everything green across the board. All 11 sectors were pushing higher and positive. Incredible momentum, incredible strength and volume coming in for the entire market, for S&P 500, for the NASDAQ, for a lot of individual stocks. So again, if you come over to the entire market here, taking a look at S&P 500, incredible day. New all-time highs, well over 1%, just over 5,600 on the S&P 500 here. Of course, incredibly overbought, and the NASDAQ here for the first time ever trading up to over 18,600. Of course, we know that it's incredibly overbought on the RSI and the MACD as well. As we've already pointed out in my previous videos, certain support levels to watch for the entire market. But I'm going to be honest with you guys, a lot of the technical analysis is starting to look irrelevant. I'll be honest, it is looking irrelevant to analyze the market right now, because of the very fact that it keeps pushing up. Every single day we're moving higher. Every single day we're hitting a new all-time high. So if you're watching this video and you think to yourself, why am I watching? Like, what's the purpose of me watching his content or anybody's content or reading anything about the market when all the market does is move higher and higher, just new all-time highs every single day? I understand. It sounds useless. It sounds absolutely irrelevant. And right now, I'm kind of like the same way. If the markets keep pushing higher, there's really not much for me to go over, not really much for me to talk about, because Apple's at an all-time high, Nvidia's at an all-time high, Tesla has been ripping higher, right? So incredibly overbought. Amazon's near all-time high, Google is at an all-time high, Meta is near all-time highs, Netflix is at a 52-week high, Advanced Micro Devices has been ripping higher, so it's pushing up to very, very significant levels. So Microsoft at an all-time high. So every single stock, every single company here in the Magnificent Seven, and of course the top 10, trading at all-time highs. The markets are at an all-time highs. So there's really not much in terms of technical analysis. Yes, I can go over every single chart and go over, oh, overbought, 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 overextended, overextended, overbought, overextended. That's it. That's all you're going to get from most stocks here. So the only thing that I want to go over is the MoneyVest index. That's it. That's the only thing I want to go over, is the MoneyVest index here yesterday pushed higher for the right reasons, right? Got up to as much as 3.86. Volatility continues to come down, so we're looking at volatility at 12.84. Yesterday was one of those odd days where both the VIX and the markets were higher. Happens, sometimes, because volatility is not a directional index in general. It's a little bit more of a volatility, again, feeder index, telling us more about the S&P 500's options contracts here. But if you take a look at the MoneyVest index here, also moving higher at 3.86. So we'll keep a close eye on this. This is really the key indicator that I look at and I watch when I'm when I'm doing my full analysis, and of course when I'm making decisions whether it's time to start buying or not in the market. So this is what my main focus is going to be. So really, when we come down to these green rectangles, these green areas, that's where most of the opportunity, that's where the risk reward is going to be the best. And the last significant buying opportunity that we got was back on April 20th, as I'd already mentioned before. And prior to that, we're looking at October 2023. So the next time, and I can promise you there will be a next time. This is something that I can promise you. I can almost 99% I can guarantee you that there will be the next time where the markets are coming down, when the MoneyVest index is down in the 3s, in the 2.4s, in the 2s, and volatility is higher. And that's when a lot of this content, a lot of this analysis is going to be significantly, I would say 10 times more useful than it is right now. Because right now it's the type of market where you just sit back, enjoy the gains, and let the market do the legwork for you. You've already invested, you've already picked the right stocks, you've already, made your decisions, and let the markets do most of the work right now. We've got a lot of amazing investors, long-term investors in our community that are just raking in the profits right now. They're quite literally invested, sitting back. Even yesterday, we just literally had a member yesterday talk about an amazing story. So this is something that I really, really love, right? So this is what I posted in our Instagram as well. But this member, a shout out to him or her, I'm not exactly sure. But this right here is our member who posted an amazing story, right? So basically, this is what they posted. So, hey, 2-year investing journey today. Many plays were inspired by your analysis or stocks you made me discover, and thank you, Caddy. Definitely got in at lucky time too, but nevertheless, you played a big part in it. And I don't want to take all the credit, because it's this person's hard work and analysis and research that have really led them to 111% profit, right? So more than doubling in since inception in 2 years, right? So again, a lot of people really appreciating that. A lot of people really like to see that. And that's what it's all about. That's quite literally all investing is about, is you make the hard decisions, you put in the work, right? And then you let the markets do all the work for you. You just sit back, enjoy. And it's times like these where you may feel like there's not really much to do, and there's not really much to research or analyze, or really, when it comes to the markets, it's the same thing over and over again. Everything becomes irrelevant. Everything becomes useless because the markets keep pushing higher. But that's not always the case, and we know that. I can tell you, markets are going to come back down. They're going to give us a pullback. They're going to give us a dip. They're going to give us a buying opportunity. And that's when we're going to deploy even more cash. We're going to deploy even more money and investing for the long term. So thank you so much for joining. I just wanted to break this down. Hope you all enjoyed it, found it helpful. Make sure that you drop a like, subscribe to the channel. Also, don't forget, join our MoneyVest platform. We got 4 spots left with a 51% discount. You can lock in for life until you cancel. You'll get access to this entire platform. And of course, a lot of our analysis is going to be available on this platform as well, where you can plot for a lot of amazing things that are available on this platform as well. Visualize a lot of the data, looking at annual, quarterly data, whatever you want to do. You can do that using our platform. So link's going to be down below. As always, happy investing. I'll see you all in the next video.